Hello everyone, welcome to your Algo Lab. Today we're diving into a new strategy for backtesting, the monthly moving average change. If you haven't had a chance to watch our earlier episodes on technical strategies, we highly recommend checking them out. You can find the links to those episodes in the description below. Without further ado, let's jump right in. In episodes 4 to 6, we explored the monthly resampled moving average strategy. This approach effectively reduces noise within the price data and generates signals only at the end of each month. A signal is triggered based on whether the price is above or below the monthly moving average. Today, we're testing a different method for signal generation, evaluating whether the monthly moving average is rising or falling. If the monthly moving average is higher than it was a month ago, we consider the market to be in a bullish trend. Conversely, if the monthly moving average is lower than it was a month ago, we identify the market as being in a bearish trend. If you're enjoying our content, be sure to like, subscribe, and hit the bell icon to stay updated. Now, without further ado, let's dive into the backtesting. Backtesting long-term signals can be challenging because traditional backtesting methodologies don't work well on long-term indicators due to the limited number of signals triggered. To overcome this, we look for commonalities across different markets, which helps guide us in selecting reliable indicators. In this episode, we'll be examining equity indices from around the globe. In later episodes, we'll explore other asset classes as well. From the United States, we have the S&P 500, the Nasdaq, and the small-cap Russell 2000. Moving to Canada, we have the TSX Composite. In Europe, our focus will be on the Eurostoxx 50, the German DAX price index, the French CAC 40, Spain's IBEX 35, Italy's FTSE MIB, UK's FTSE 100, and the Swiss SMI. In Asia, we'll examine Japan's Nikkei 225, the Hong Kong Hang Seng Index, and Australia's ASX 200. We've collected data starting from 1980. For indices that began trading after this date, we've used the earliest available historical data. We've chosen price indices because reinvested dividends can distort the calculation of the long-term moving average. Let's set up our benchmark. Our benchmark will be a buy and hold strategy on equity price indices. Here are the benchmark buy and hold returns. For example, the benchmark buy and hold return on the S&P 500 was 9.00%. Just a quick reminder, this is the price return without including reinvested dividends. Returns are just one facet of an investment. We also need to consider risk. Our preferred measure for this is maximum drawdown, MDD. Maximum drawdown assesses the risk of an investment by representing the maximum observed loss from a peak to a trough in a portfolio before a new peak is achieved. In simpler terms, it shows the largest drop in the value of an investment from its highest point to its lowest point. For instance, the maximum drawdown in this example is minus 25%. Understanding maximum drawdown helps investors evaluate potential downside risk and determine appropriate position sizing. Here is our table of maximum drawdowns for the buy and hold strategy. For example, during the testing period, the S&P 500 experienced a maximum peak to trough loss of 56.78%. The Nasdaq saw a peak to trough loss of 82.90% during the dot-com bubble. Finally, we have our risk-adjusted measure, the maximum drawdown adjusted return. The MDD adjusted return is the ratio between the annualized return and the maximum drawdown. While it is not the only risk-adjusted measure, it is simple and effective. Here's the results for our 10-month moving average change strategy. We have highlighted the instances where the strategy outperformed the benchmark for clarity. For example, with the S&P 500, the strategy did not outperform the benchmark in terms of overall return, but achieved a smaller maximum drawdown. Overall, while the average returns were lower compared to the benchmarks, the strategy effectively reduced the maximum drawdown. This is understandable as it helped avoid the most extreme periods of bear markets. In terms of risk-adjusted returns, the 10-month moving average change strategy performed better across most indices. This consistency is crucial, as it suggests the indicator is effective across similar asset classes. Let's compare our 10-month moving average change strategy with previously tested ones. For these comparisons, we are using the S&P 500 as the underlying index. In terms of returns, the 10-month moving average change strategy is among the best performing strategies. Regarding risk, it aligns well with the other strategies. Additionally, this strategy generates fewer signals while maintaining a good win rate. When developing a successful system, we rarely rely on a single indicator. The first step is to establish a sufficiently large number of profitable indicators. Given this approach, we're satisfied with the results of the 10-month moving average change. In the next episode, we'll conduct a simple grid search to explore whether we can further enhance our 10-month moving average change strategy. If you like our channel, make sure to like, subscribe, and hit the bell icon to stay updated with our latest content. Thank you for watching, and see you next time.